Hi, I'm Ross Mayfield, investment strategist at Baird, and we are back for another weekly update with our friends at Strategas. Today, we are lucky enough to be joined by managing director and senior investment strategist Ryan Grabinski. Ryan, how are you doing today?
I'm doing well. It's we're getting to the tail end of summer and things are going well. How about yourself?
Yeah, we're good. We're good. Things are cooling down here. Markets at all-time highs, so not a lot to complain about. I want to start with what I think is probably the most important and maybe most under discussed reason that the market is sitting near all-time highs as we record this, which is the fundamental backdrop. The earnings backdrop has just been really strong. We're at the tail end of an earnings season that has been better than expected, and I'm just going to turn it over to you. What are you seeing? What is driving this? Do you agree with the assertion that the fundamentals are a key driver of stocks here?
Yeah, I think the fundamentals really are everything at the end of the day right now. At the beginning of the earnings season, the 2Q earnings season, growth was expected to be about 5.8%, called 6% overall for the S&P 500. That figure, as we get to the tail end of earnings season, is coming in at close to 13%. And we do have Nvidia to report at the end of the month. And so that's really the last company that could really change the trajectory of the earnings outlook overall. But overall, things have been strong. If we look at it on a sector basis, 9 of the 11 sectors in the S&P 500 are exceeding the July 1st estimate. So it's really a broad-based story of how strong the fundamental picture is. That's on the earnings side. If we look at the revenue side of things, which was largely expected to slow due to tariffs in the second quarter, it actually accelerated. Over the last 4 quarters, the average revenue growth has been about 5.5%. This quarter, it's actually at north of 6%. So all things considered, the 2Q earnings season was quite strong, and the fundamentals really have been supportive of the market. If we look ahead into the rest of the year, the 2Q quarter was actually expected to be the trough for earnings. And so, things really aren't expected to get too terrible from here moving forward. Thinking about 2025 overall, obviously the strong 2Q number has actually boosted the 2025 EPS number. So now we're actually getting back to close to $270 a share overall. And then even if we look into 2026, there's really no slowdown that's being priced into analyst estimates. We're looking at a 13% growth rate expected for 2026. Frankly, it feels as though we're firing on all cylinders right now within corporate profits for the indexes.
Well, let's talk a little bit about the tariff impact on that. Obviously, we've kind of been in a pause period, but tariffs are ramping up. There's been a lot of anxiety about the tariffs, and yet, as you just made the case, they haven't really hit the fundamentals yet. I'm curious if you're seeing evidence that tariffs are starting to eat at profits at all, whether it's in margins, whether companies are eating the tariffs, suppliers, consumers. We were just talking before this about some consumer stocks that were doing really well. Are you seeing the tariffs anywhere? And then are companies talking about it or planning for it any differently when you listen to these earnings calls?
So I would say there's really two things. In aggregate, there's the tariff impact has been very minimal, right? So typically when we look at operating margins, if the tariffs were playing a big role, would actually decline. I look at the next 12-month estimated operating margin. Heading into the 2Q earnings season, there was an expectation that it would come down a little bit. That expectation has all been removed, and we're continuing to approach the all-time highs for operating margins at about 17.8, 17.9% overall. Of course, if you look at everything on an individual company basis, there may be a company here or a company there that's citing tariffs as a reason for weak sales. We were talking about the restaurant industry just before we started recording this, and it's really a bifurcated industry. What I'm really focused on is companies that are using tariffs as excuses right now, because they have the cover to be able to use that. When I listen to management calls, one of the things they're saying is that it may ultimately be an impact in the fourth quarter, but they continue to push out the expectations for when tariffs are ultimately going to have an impact. I think as we think about the negotiations that are happening on a daily basis in Washington, the administration is certainly conscious of the fact that they could have negative impacts. And so they take that into account. And, we've seen that with the China negotiations. It continuously just gets pushed out, pushed out, pushed out. there's really not a desire to upend corporate businesses here in the U.S. And I think for that reason, analysts have been hesitant to actually incorporate that into their estimates moving forward, and therefore the reason why management's also not including it in their guidance.
Well, Ryan, this has been a great look at the fundamentals. Again, somehow stock fundamentals seem to often get overlooked from all the noise that comes out of Washington or other headwinds that might be out there. But this has been a really good bedrock underneath the market, and I appreciate you shedding some light on it. We'll look forward to talking to you again soon.
Absolutely.